market. But Fook Yap, who's the senior investment strategist at Standard Chartered Bank, joins us now to tell us what he's made of the entire macro situation. Fook, thanks a lot for joining in. First of all, Happy New Year to you and your entire team at Standard Chartered Bank. Hopefully this will be a year better than the previous one. Not that the previous one was bad, but what is your own expectation of how things would shape up? Of course, all eyes will be on the rate cutting cycle by the US Fed and back home by the RBI as well. There's the jobs report due later today. But what do you think is front and center on the investors' minds?
Yeah, thanks very much. Happy New Year to you too. So, yeah, I mean, we are entering the year a bit more constructive, especially for the first half of the year. But I think, front and center is still very much as to whether inflation can be controlled and do we get a recession in the US. Now, our expectation is that inflation will come down, and the US CPI print next week is another very important data point. But as inflation comes down, it gives the Fed more flexibility to react and respond via rate cuts. So we think that as inflation comes down, the Fed will have the ability to use rate cuts again to support the economy, and mainly coming through in the second half of the year, and that will be supportive and positive for the US economy. And the question as well about recession and whether that will happen or not. I mean, our traditional indicators of a recession in the US, like your inverted yield curve, leading economic indicators, they're still very much in the camp that there is going to be a US recession. Now, could it be different this time? I will have to watch. But our view is that in the first half of the year, at least, will be okay. That's why we are constructive on equities and bonds. But we are very watchful as to what happens in the second half of the year. But our base case for this year, really, in the US is for a soft landing. What that means is that below trend growth, but still positive. So those are the two main things I would think is to watch: recession and inflation.
Okay, Fook, hi, good to have you on the show, and season's greetings to you. What is the view on India, a market that had a fantastic run in 2023? So we're starting at fairly elevated levels. There's this big debate about valuations. What's your call here?
Yeah, we do like the India equity market. We're constructive on global equities generally, actually, just because of the narrative of a soft landing coming in and rate cut expectations coming in. We think that's actually supportive for equities globally, including in India. What we're seeing now is a bit of consolidation, which is expected. We think there will be a bit of a consolidation led by the tech sector in the US, as you said. But globally, we do like equities. I mean, India equities continue to be very, very strong performers. We think the earnings growth will continue to deliver in the mid-teens earnings growth this year and next year. We've got pre-election spending possibly coming in to be supportive. We think the investor holdings of India equities has been coming up, but it's still low compared to previous years. So we think those are all positive factors for India. They'll support India equities continue to grow. It is a core holding for us, especially on a medium-term outlook.
So India is a core holding in your portfolio. In terms of in Asia, ex-Japan, or in emerging market, what is India's pecking order? And have you increased your weightage on India, or are you likely to do so?
Yeah, we've been having India as a core holding for some time. If you ask me for a pecking order, that's always a difficult question to answer. But within Asia ex-Japan, our preference actually is for Korea at the moment. Korea is a very cyclical market. Last year, we saw earnings dip a lot because of the semiconductor cycle. But we do believe the semiconductor cycle has pretty much bottomed in Q3 of last year, 2023. And that's why, as we expect semiconductors to improve, inventory restocking to happen, they'll be very supportive for Korea. So in terms of pecking order, actually, Korea is our preferred market within Asia ex-Japan because of the reason I mentioned, the semiconductor supporting earnings growth expanding there.
All right, Fook, we'll leave it at that. Thanks a lot for joining in. I appreciate your thoughts. That's a word coming in on the global markets. Let's